Welcome viewers. Today we delve into a topic of paramount importance to businesses across India. The latest amendment to Income Tax Act, Section 43B, Clause H. A provision that sets to redefine the financial interaction between businesses and micro and small enterprise or MSEs. And who better to navigate us through these intricacies than Sunil MALOO and Company, a distinguished chartered accountant firm renowned for their expertise in direct taxes and complex income tax litigations. Today we are not just discussing what and why of Section 43B Clause H, we are exploring its real-world implications, challenges and best practices through a series of carefully curated FAQs. To kickstart our FAQ session, let's begin with the basics. What exactly is Section 43B Clause H and why it has been introduced?
Section 43B Clause H is a new provision in the Income Tax Act mandating that any sum payable by an assessee to an MSE must be paid within the prescribed period under the MSMED Act. If not, such expense will not be deducted for the purpose of taxation and will be considered as your income. The primary aim here is to promote the timely payment to MSMEs.
Moving on to our next question. From which date does Section 43B Clause H become applicable? And how should businesses treat opening balances outstanding as of the date of applicability?
Section 43B Clause H becomes applicable from 1st of April 2023, affecting the assessment year 2024 and 25 and onwards. As regards the opening balances, the new provision does not operate retrospectively. Therefore, opening balances as on the 1st of the April 2023 are not covered under the new law.
Diving deeper into the nuances of Section 43B Clause H, a critical aspect for businesses to understand is the classification criteria for MSEs. How are these classifications determined, and is there a possibility of them being updated annually?
A classification of MSE is pivotal indeed. As per the MSMED Act, MSEs are classified based on their investment in plant and machinery and turnover.
Now, could you please elaborate on specific criteria that define micro and small enterprise?
Certainly, a micro enterprise is one where investment does not exceed 1 crore and the annual turnover does not exceed rupees 5 crores. A small enterprise, on the other hand, is defined by an investment limit of 10 crore rupees and turnover of less than 50 crore rupees.
That's quite clear. But with changes in amount of investment in plant and machinery or turnover, is there a possibility that classification might be updated annually?
Yes, the possibility of upward and downward graduation exists. The notification of MSME clearly states that MSME classification is not permanent. It will change based on the yearly numbers of the investment in plant and machinery and turnover.
Oh, that's interesting. So how can businesses stay informed about any changes to these criteria?
On MSE portal, there is a tab called Udyam Verify. One can visit that link and get the latest status of MSE registered entity.
An interesting query that we often encounter is about scope of MSE classification, particularly whether goods purchased from traders fall under the ambit of MSE. Could you please shed some light on this?
This question is actually relevant for most of the businesses. Under the current framework, the MSME classification primarily applies to manufacturing entity and service provider. Traders, whether wholesaler or retailer, would not basically cover under the MSE definition. They are not enterprise as per the definition 2E of MSMED Act. They are allowed MSME registration only for the priority sector lending and not for any other benefits of MSME. So, in essence, a business purchases goods from a trader, those transactions would not be covered for the purpose of Section 43B Clause H.
A key aspect of managing finances, especially in light of Section 43B Clause H, revolves around the understanding of due date under Section 15 of MSMED Act. So could you please explain what this due date signifies and its relevance?
Certainly, The due date under Section 15 of MSMED Act is crucial for businesses dealing with the MSE. It specifies maximum time allowed for settling the payments with MSE suppliers. This period can run up to maximum of 45 days from the receipt of goods and services.
And what role does fixing the credit period in writing play in this context?
Fixing the credit period in writing is fundamental. In context of Section 43B Clause H, if the credit period is not decided in writing, then by default it will be taken to 15 days only.
Let's delve into a more detailed analysis of Section 43B Clause H and its interplay with Section 15 of MSMED Act. Could you please guide us through this analysis?
Absolutely. We will understand the interplay of Section 43B Clause H with the Section 15 of MSMED Act with the help of a graphical chart. In this chart, sum payable to MSE suppliers as on the year end are divided into two parts. First stream is that payment which are outstanding as on 31st March which are beyond the due date specified under Section 15. In that case, the entire amount needs to be disallowed as it is already beyond the due date of Section 15. Under the second category of chart, those are the payment which are outstanding on 31st March but the due date of Section 15 has not expired as on 31st March. These payments will become due in the next fiscal year, and in that year two situations would emerge. If it is paid within the due date of Section 15 and if it is paid beyond the due date of Section 15 in the next fiscal years. Now under the situation 1, if it is paid within the due date of Section 15, then no disallowance is required. It will be allowed on the accrual basis in this 31st March 24 itself. Now if in case of second scenario, if it is paid in the next year but beyond the due date of Section 15, then the entire amount need to be disallowed in this year and will be allowed in the next year based on the payment based.
Given the nuances of Section 43B Clause H, could you please explain how it distinctly differs from the other clauses which are within the Section 43B, especially in terms of deductions and tracking payments?
Certainly, a fundamental difference lies in treatment of deductions. Other clauses of 43B generally allows businesses a window beyond the fiscal year end up to the filing deadline of return under Section 139(1) to make the payment and still claim the deductions. Section 43B Clause H deviates significantly by not tying the deductibility of payments to the due date of filing of return under 139(1). Instead, it exclusively relies on the due date of payment as per Section 15 of MSMED Act. Now, with Section 43B Clause H, businesses must meticulously identify and disallow any overdue amounts outstanding as on 31st March. Furthermore, they must vigilantly track every invoice outstanding as on 31st March to ensure payment is made well within the due dates as prescribed under Section 15 of MSMED Act.
Now, a significant concern for businesses, particularly involved in development and work contracts, relates to the impact of Section 43B Clause H on retention money. Could you please explain this issue?
Retention money and security deposit are crucial element in development and works contract, often settled within 2 to 3 years from the invoice date. These are deducted from the invoice, leading to net payment with the full invoice amount recognized as expense.
So how does this Section 43B Clause H affect these practices?
Section 43B Clause H introduces a significant shift by potentially disallowing the retention money and security deposit payments if they are extended beyond the due date as specified in Section 15 of MSMED Act. This means that the traditional practice of settling retention money and security deposit over an extended period could lead to non-deductibility for tax purpose if not aligned with Section 15 timelines.
That sounds like it could have a substantial impact on businesses. So how can they adapt?
The impact is indeed significant. Businesses might need to explore alternative solutions like bank guarantee, escrow mechanism to comply with the provision of Section 43B Clause H. while still managing their cash flow effectively.
Another area of interest under Section 43B Clause H pertains to its impact on capital goods. How does this provision affect the treatment of capital goods, particularly for businesses engaging with MSEs?
Section 43B applies only to expenditure which are to be claimed as deduction in computation of the business income. In my view, supplier of the capital goods are out of the ambit of Section 43B.
Now, another area that often raises questions is the impact of Section 43B Clause H on the provision of expenses, especially in context of businesses engaging with MSEs. Can you please elaborate on how this provision influences accounting practices?
Provision for expenditure is merely an accounting treatment. Provision does not become payable unless underlying performance obligations are performed. Therefore, in our view, Section 43B Clause H should not apply to provision made for the expenses.
Another pertinent question many taxpayers have: whether Section 43B Clause H applies to assessees who opt for presumptive taxation mechanism under Section 44AD and 44ADA of Income Tax Act. Could you please clarify this for our viewers?
Both Section 43B and 44AD and ADA are framed in a non-obstante clause, meaning they have overriding effect over other provisions in certain scenarios.
So how do these non-obstant clauses interact when it's come to presumptive taxation?
In our interpretation, both Section 44AD and ADA, which works about the presumptive taxation, provides a specific framework for determining the business income. Section 43B Clause H would not typically apply to such kinds of assessing.
So this interpretation would certainly offer relief to many small and medium-sized enterprises opting for presumptive taxation.
Absolutely, it aligns with the legislative intent to simplify tax compliance for smaller businesses, allowing them to focus more on their operation and less on the intricacy of the tax provisions.
With the introduction of Section 43B Clause H, what are the primary challenges that businesses and auditors might face in ensuring compliance?
In my view, businesses are going to face lot of challenges. These challenges would be in form of strained cash flow, managing the clash of industry credit period with the legal mandate of this section, increased administrative burdens, and risk of more legal disputes. Apart from all these challenges, one more challenge would be to handle the potential market distortions, as now the businesses may prefer buying goods and services from non-MSE entities. On the other hand, auditors would also face lot of challenges while reporting for Clause 43B Clause H under the tax audit report.
Navigating the complexities of the Section 43BH requires a strategic approach. Could you outline the best practices businesses should adopt to ensure the compliance?
Absolutely. Compliance with Section 43BH is multifaceted, demanding a proactive and systematic approach, such as identification of the MSE suppliers, proper documentations, regular monitoring of outstanding balances, prompt dispute resolutions. Utilizing technology for compliance can significantly streamline the processes.
As we wrap up today's in-depth exploration of Section 43B Clause H and its far-reaching implications, we hope this session has provided you with valuable insights and clarity. But the conversation doesn't end here. We understand that each business is unique and you may have some specific questions or scenarios that you would like to discuss. The team of Sunil MALOO and Company is here to support you, offering the expertise and guidance you need. Thank you for joining in this important discussion. Until next time, take care and we look forward to supporting you on your journey of compliance and beyond.